Thanks everyone for joining. My name is Gary Robinson. I'm one of the investors on the US equity team at Baillie Gifford, and I co-manage both the Baillie Gifford American Fund, our open-ended OIC, and the Baillie Gifford US Growth Trust, which is a closed-ended vehicle that can invest in both public and private companies. And today I'm going to talk to you about innovation and technology-led change. And I'm going to make the case that we are still early in the current technological revolution and give you examples of some of the companies and themes that we're excited about for the next 5 to 10 years. Before we get to that, I wanted to briefly talk about our philosophy and approach. 3 key points are on the left-hand side of this slide. In short, what makes us different is, first of all, we're long-term. So we invest on a 5 to 10 year view, and that's reflected in low portfolio turnover, and that's underpinned by our corporate structure. We're a private partnership wholly owned by the 47 partners that work full-time in the firm. We don't have to answer to outside shareholders. We can run our business for the long term, and that gets reflected in the way that we run our clients' portfolios. Number 2, we're genuinely active. We pick stocks based on how much we like them rather than how big a constituent of the index they happen to be. To beat the index, you have to be willing to be different from it, and you have to be willing to tolerate the volatility that comes with that. So, the portfolios that we run are more volatile than average, both in absolute and in relative terms. But we think that's a necessary component of delivering exceptional long-term returns. And then the final point here is that we are growth investors. We're out and out growth investors. We believe growth companies are the engines of long-term wealth creation, and we're looking for the innovative growth companies that are going to drive progress for the next decade and longer. And just moving on to the next slide, the reason why we're focused on growth companies in particular is neatly summed up on this slide. And it's because if you look at the stock market over the very long term, what you find is that exceptional growth companies have driven the vast majority of the market returns. What this slide shows is that over the last 90 years, half of the net excess return for the stock market came from just 0.4% of the firms. That tiny sliver of green on the left-hand chart there, the 90 firms out of 25,000 accounted for that big chunk of green on the right-hand chart there. That's 50% of the total net excess wealth creation. And these outliers were by and large growth stocks. And these are the innovative companies that we're trying to identify and own within the US funds. Now, this is a very long-term study, but importantly, this pattern of asymmetry that we see over the very long term holds over shorter periods. So this graph on the right-hand side here shows the distribution of returns for the S&P 500 over rolling 5-year periods between 1985 and 2020. And what we see is the same pattern that we saw on the previous slide, albeit less extreme. The blue shaded region on the right-hand side here, that represents the top 20% of companies, and these top 20% of companies contribute a disproportionate amount of the market return. Companies on the left-hand side of this chart, to the left of the blue shaded region, do a little bit better than netting each other out on average. It's the outliers on the right-hand side of this chart that matter. And this asymmetry, the outlier-like returns from those small number of companies, are what really matter in equity investing. It's the winners that drive the stock market return. There's a power law distribution in public markets, just like in private markets. You don't have to get it right very often. What matters is that you make a lot of money when you are right. And this underpins the philosophy and the approach that we take with the American Fund and the US Growth Trust. Moving on to the next slide, this touches on our US equity credentials. The one thing on this slide that I wanted to draw your attention to is just the first line, which says, we've been investing in US innovation for over 100 years, which is true. Baillie Gifford was founded in 1908, and not long after that, we were making investments into US railroads and Malaysian rubber plantations. And the rubber plantations were making rubber for tires that were being used on the Ford Model T, which was just starting to roll off the production lines in Detroit around about the same time that Baillie Gifford was founded. So we are investing in US innovation then, and when you fast forward to today and see that we have a large position in Tesla in the portfolio, in some ways we've just come back full circle to where we started over a century ago in backing innovations that are transforming the transportation industry and other industries around the world. Speaking of the Model T, I think one of the things that the market tends to consistently underappreciate is just how quick change can happen once it gets going. And I think this slide sums that point up very, very nicely. So this slide shows Fifth Avenue in 1900 and 1913. And you can see on the left-hand side the shop from 1900. And there's not a, I think there's a single motor vehicle across the Fifth Avenue in this slide here. Every vehicle apart from one is a horse and carriage. And then if you fast forward 13 years to 1913, the exact opposite is the case. There's a single horse and carriage in this picture, and every other vehicle on the road is a motor vehicle. And the reason I wanted to mention this is because this point in time, there are parallels between what was happening then back in 1908 and what's happening today. But the Model T marked the start of a previous wave of innovation. It was the beginning of the age of oil, the motor car and mass manufacturing. And in the 70 years after the Model T was launched, these new technologies and techniques like cars and mass manufacturing transformed cities and transformed industries and reshaped the production capacity of the whole global economy. And it's interesting to study these previous technological revolutions like the one that was driven by the Model T, because they can give us some idea, some hints about what we might be dealing with now. You know, as they say, history doesn't repeat, but it often does rhyme. And there's a really interesting academic called Carlota Perez who's done some phenomenal work in this area. I'd really recommend her book, which is called Technological Revolutions in Financial Capital. And what she found was, looking back over the last 250 years, there have been 5 major waves of innovation, starting with the Industrial Revolution. So we had the Industrial Revolution, first of all, which started back in the late 1700s when Arkwright's mill opened up in Cromford. The second technological revolution was the age of steam and railways in the early 1800s. The third technological revolution was steel and electricity in the late 1800s. And then we had the Model T and the age of oil and cars and mass manufacturing in the early 1900s. And then the 5th technological revolution is the one that we're in today, the one that we're in right now, the information technology revolution. And one of the really interesting things that Carlota Perez noticed was that all 5 of these waves of innovation followed a similar pattern. And that's sort of summarized on the slide here. They all took a really long time to play out. We're talking half a century or even longer in some cases. And each of these waves were split into 2 distinct phases. In the first half of each revolution, the new technologies associated with each of the waves were confined to a relatively narrow part of the economy. They were adopted by just a couple of sectors or countries. And this created a lot of turbulence because you had a lot of capital chasing a small number of opportunities. And because the technologies were narrowly deployed, there was increasing income inequality and social unrest, which obviously has some familiarity with what we've just been through in the last decade or 2. But then in the second half of these waves, the new technologies of the particular technological paradigm started to spread out to the wider economy. And this resulted in a golden era for employment, for economic growth, and for opportunities. And Carlota Perez called the turbulent period the installation phase, and the golden era the deployment phase. And you can see these phases represented on the graph on this slide. So perhaps we can use this model as a map to try and pinpoint where we are today in the current technological revolution. And I personally think we're at the point where we're transitioning from that narrow, turbulent installation phase to the broader golden era or deployment phase. The current technological revolution has come about on the back of new technologies like internet, which has increased connectivity, mobile, which has increased availability, and AI, which has made machines smarter. And over the last decade or two, just like Perez's model predicted, these technologies have been confined to a few narrow sectors of the economy like media and advertising, communication and retail. And we've seen the impact of this. We've seen that the companies that have been embracing these technologies have been able to generate huge value for consumers and shareholders. And some of the obvious examples would be the likes of Google and Facebook in advertising, Amazon in retail, Apple in communications. And the incumbent companies like newspapers and bricks and mortar retailers have been on the wrong side of these changes and have struggled to adapt, and lots of market cap has been destroyed. We've also had social unrest and increasing income inequality, and all the things that Perez observed in previous technological revolutions, which is interesting. And the wealth from this revolution has been concentrated in a few industries and in the hands of a few people. But when we fast forward and look at the market today, I think what we're now seeing is these new technologies are starting to spread out and impact a much wider range of industries. One example is the healthcare sector. You know, in the US at least, it's a large and efficient market that hasn't changed much in the last 50 years. But today, we're starting to see new technologies like genomics and automation and AI being adopted across a broad swathe of the industry, from drug discovery to manufacturing to diagnostics, which is leading to higher returns in R&D and better outcomes for patients. Another example is the energy sector, where we've seen solar moving down the cost curve rapidly to the point where in some places in America, it's almost cheaper to build new solar plants than to maintain existing coal or oil-fired ones. And solar has the opposite characteristic of fossil fuels. The more fossil fuels we use, the harder it gets to extract the remaining fossil fuels out of the ground. Solar, on the other hand, is following the classic technology cost curve, Wright's law, and it's going to keep getting cheaper and cheaper every year to the point where energy will become clean, abundant, and almost free. And we're seeing changes in the enterprise technology space, where we're moving from expensive on-premise IT equipment to a cloud-based delivery model. Instead of having expensive kit that you're running for yourself, you can rent computing power from the likes of AWS and consume what you want, when you want, on demand, over the internet. And this is helping to reduce the cost of starting and scaling businesses, and it's also making businesses more agile and making it easier for them to use their data effectively. And as the technological revolution speeds up and spreads out to new sectors, it's creating opportunities for new companies to come along and capitalize on or even drive this change. So Moderna is a great example in the healthcare space. You know, prior to Moderna, drug development was pretty much a spaghetti at the wall approach. Throw lots of molecules at the problem and see what sticks. Moderna's now come along and is changing the nature of drug development. It's built a programmable platform, which is enabling us to develop drugs faster, more cheaply, and with a higher success rate than before. And it's using technologies like genome sequencing, automation, and AI to make the business more efficient. We've benefited hugely from this during the pandemic. Moderna was able to design its vaccine in just a couple of days and had it ready to be injected into the arms of patients within about a month. Some other examples of companies that are capitalizing on these paradigm shifts within the portfolio would include a company like Stripe, a fintech company that is building a software layer over the financial sector. The US Growth Trust is a closed-ended fund, so it's got the ability to invest in private companies, and Stripe is one of those private companies and is a top 10 holding in the trust. The financial sector is really difficult to navigate. There are, as you go from different regions and different countries to other countries, the banks change, the regulations change, the regulators change, the mobile wallets change, the credit card rails change, and it's just an incredibly difficult landscape for any company to navigate, never mind a startup. But what Stripe has done is built an abstraction layer above that complexity using software. And now if you want to accept or send payments online, all you need to do is plug into Stripe with a few lines of code. Again, making it dramatically easier to start and scale businesses. And Tesla, another example, which you all know, I'm sure, is upending the auto industry and energy markets. And in each of these segments, it's still really, really early. The vast majority of demand in each of these sectors is still in the hands of incumbents that are doing things the old way, which creates a huge amount of opportunity ahead for these new entrants. For example, electric vehicles still only have a single-digit share of overall global auto sales, and I think that figure will go a lot higher over the long term. So what I'm trying to say is that we are at a really, I think, exciting point for growth investing, where the current technological revolution is speeding up and spreading out and affecting more segments of the economy, which is creating opportunities for entrepreneurs. We're still early in this digital transformation. But as I'm sure most of you have noted, this hasn't translated into strong performance at the individual stock or overall portfolio level of late. Quite the opposite. Growth investing has been out of favour. The US Growth Trust has performed very poorly in the short term, and there are lots of individual holdings in the portfolio, lots of disruptive companies which have seen their share prices fall by 50% or even more. And I don't want to trivialise this. It's a difficult thing for investors and for savers to endure volatility such as this. But the point I want to make is that volatility is inevitable in investing, and it's how you respond to it that matters. And the chart on this page shows 3 of the most successful investments for a US equity team over the last 10 years. Now, this data is from the American fund rather than the US Growth Trust, which hasn't been around for long enough for us to have a long enough record to show. But this chart shows 3 of the most successful investments for the US equity team. Since we've owned Tesla, it's up 22-fold. Since we've owned Shopify, it's up 13-fold. Since we've owned Nvidia, it's up 12-fold. So these have been the outlier type stocks that I talked about earlier, the sorts of companies that drive stock market returns, the asymmetry that's so important in equity investing. But you'll also notice that underneath each of these bars, there are lots of little smaller bars. And what these represent are instances where each of these stocks declined by more than 10% from their peak. And with Tesla, we've had 10 such drawdowns since we owned it. With Shopify, we've had 13. With Nvidia, it's fallen more than 10%, 15 times. So even with these great companies that have delivered spectacular long-term returns, they've been out of favor with the market regularly during their period of ownership. And holding on to these stocks when they've been declining hasn't been easy. It requires conviction in the investment cases, conviction in the philosophy and process, and the right sort of organizational structure to handle that volatility.
Sorry to interrupt, Gary. We're just a bit over time here, Gary. Sorry to interrupt. Can I ask you to conclude?
Okay, I'll conclude by saying that the introduction to the presentation and the work I was referencing from Carlos Perez is really about making this point that the conditions are right for strong fundamental underpinnings for growth stocks. Fundamental strength doesn't necessarily translate into strong stock price performance in the short term, and the short-term share prices are volatile and unpredictable. But what this last chart here shows is that over the long term, performance is strongly correlated with fundamental performance. Companies that grow their earnings fastest outperform. Companies grow their revenues fastest outperform. We don't know what the markets are going to do this quarter, next quarter, or even next year. But as long as the companies that we invest in are delivering strong fundamental performance based on their innovative business models and their entrepreneurial cultures, then we think that creates a very strong underpinning for long-term opportunities.